Hello, and welcome to our second quarter 2015 review of our strategy session, which was held last week right here in this room. And at that session was, on my left, Len Schill, CEO and Vice President of the firm, and on my right, Bob Toomey, who is our Director of Research and also a Vice President of the firm. We also appreciate Art Nunes, who attended the session. Unfortunately, wasn't able to make it here for the video, but Art is with Northwest Asset Management, and he is, of course, an RIA. Before I turn over the session, I'd like to just put a chart up which actually shows over the last 20 years an interesting scenario, which is out of all the choices that we can make, it shows that the average investor has actually performed very, very poorly compared to all those choices. It's one of the reasons why we do these strategy sessions, because we are also selecting from all of those, but we're also making sure that we are diversified through all of those investment categories. So as you go forward, and as Len and Bob talk about what our decisions were, I'd like you just to keep in mind that that's what we're trying to do, is to keep you, our investors, from being one of those average investors, but to perform above the average. So I'd like to now turn it over to Len, and Len is going to start off by talking about the international for the last quarter and the future.
Thank you, Stan. The international area is one where we see a number of changes, and we've actually made some changes that are a little bit significant to your portfolio. One of the things that we've done is recognize that there are, while it's not a perfect analogy, there are a lot of similarities between where Europe is right now and where the US was probably about 4 years ago. At that time, we were coming out of a recession, and Europe has just come out of a recession. We had a period of quantitative easing and stimulus to try to get the economy moving, and Europe has instituted a similar quantitative easing policy as well. And US stocks at that point had been beaten down to the point where they represented a good value, and as we all know, the market has done very well over the last several years as it's recovered a lot of that value. European stocks right now are trading somewhere in the neighborhood of, with a market cap, about 50% of their gross domestic product, as compared to the US, which is currently trading with a market cap of about 130% of its gross domestic product. So we see opportunities in Europe right now, and as such, we've emphasized Europe and gone from an underweight position in international to an overweight position right now in international. In addition to that, there are some other things going on internationally that should benefit as well. While we do not have an allocation in China, there are measures being taken by the Chinese government to stimulate their economy. They're in a period of slowdown, and anything that helps China at this point is probably going to help a lot of other regions of the world. So we see opportunities there. We've overweighted that area, and we are emphasizing Europe, and we look to hopefully exploit some of the inexpensive stocks that are available there at this time. With that, I'd like to turn it over to Bob to talk about the US stock market.
Thanks very much, Len. Well, as you're all aware, we're entering the 7th year of a bull market in US stocks, which started on March 9th of this year. There have only been a very few times over the last 100 years in which the market has, a cyclical bull market has extended beyond 5 or 6 years. So we are in unprecedented territory. When we're thinking about US stocks this quarter, one of the things we do look at, of course, are the fundamentals, and valuation is a very important part of that. The forward PE on US stocks is elevated. We think valuations for US stocks in general are elevated. The chart that you're seeing here shows the forward PE going back to 1985, and you can see that the earnings that is showing there is earnings do appear to be peaking. So we really feel that valuation has become more expensive and the risk reward in U.S. stocks has become less favorable, and hence another reason why we increased our allocation in international stocks. You've probably been, if you're watching the market, you've probably been familiar with the volatility we've seen over the last several months, which has been elevated. The reason for that are several things. First, there's been a lot of uncertainty about Federal Reserve policy. When will the Fed start raising rates? This has been a key issue for the bond markets, and that also affects the equity markets as well. So that's been causing volatility. Also, we've been seeing earnings estimates downgrades by analysts as a result of the strong dollar. And I think that there have been some impacts from that. I think that's why you've seen this rather lackluster performance in large multinational stocks here over the last quarter. The other reason for increased volatility has been concerns over global growth. And I think all those things together have really been causing investors to take pause. And as we saw through the first quarter, the U.S. stocks essentially went nowhere. They were about a little under 1%. As we go forward, we still remain constructive on the outlook for U.S. equities for several reasons. First, we think that we view the United States as a safe haven with very large and liquid securities markets. We think that capital will still come into the U.S. markets. Also, we believe after we go through a couple of quarters of discounting a slower earnings, we do think that earnings visibility will improve in the second half of this year and moving into 2016, and that should help support valuations for U.S. stocks later in the year. And the third thing is we do see opportunities for value in certain sectors of the U.S. markets, and we think that those will still be enough to support higher valuations for U.S. stocks over the next 6, 12, 18 months. One thing I would like to point out, however, is that we've seen very strong annual average returns over the last 5 years. They've been about 15%. We do not expect these kinds of returns going forward. We think that for a variety of reasons, valuation being one of them, that the market returns will be more in the mid to high single digits over the next several years for the U.S. markets. And we believe that it's important to keep those expectations in mind. And again, it's another reason why A, we're looking for opportunities in international stocks, and B, the reason why it's important, as Stan mentioned earlier, to have diversified portfolios. I would like to now turn it over to Len, who's going to talk about our fixed income strategy.
Thank you, Bob. In the fixed income area, we've recently seen some Fed action where the Fed has changed their language with respect to whether or not they are going to be patient with respect to when they're going to raise interest rates. And anybody who pays any attention to what the Fed is saying knows that the Fed watchers almost always overreact to what the Fed is saying if they change even just a syllable. We're not really concerned with this change in language. We see this as a continuation of what the Fed has always been saying that they were going to do anyway. Because while they have been patient, we felt all along that they were going to lose their patience about the middle to end of this year, and that they were going to reach a time when it was appropriate for them to start to slowly raise interest rates. And that's really what we're still seeing. This change in language is setting them up to be able to do that. With that, we have made appropriate changes to the portfolio. We are eliminating our bond substitutes so that everything that you're going to see in your bond going forward are corporate bonds. This will help reduce the volatility in your portfolio while also maintaining the integrity of our model. The other thing that we have done is, in anticipation of these rising rates, we have changed our allocation so that we are skewing things to the short end of the curve. This will get us away from the long end, which typically is more interest rate sensitive, but we're also anticipating that the short end is going to move more than the long end in this particular case. And as the short end rises, the bonds that we're holding, because they're short in duration, will turn over quickly, and we'll be able to benefit from those rising interest rates. As such, we are now holding less on the long end, more on the short end, and we see this as a benefit to you. With that, I'd like to turn it over to Bob so that he can tell you about other changes we've made in our portfolio.
Thanks a lot, Len. So that was a very, very good recap of our fixed income strategy, so I won't spend a lot of time on that. But I'd say the most significant changes that came out of our discussion this quarter were increases in our allocation to European stocks. As I said earlier, we think that the relative value that is represented in European stocks is better than U.S. stocks currently. We continue to increase our allocation to dividend growth stocks. We think that in a potentially rising rate environment, we believe large stocks that are able to, or at least perceived as being able to raise dividends, will hold up on a relative basis better than stocks that would be considered slow growth, high dividend type of stocks. So we increased allocations to things like large S&P 500 growth. We still maintain good allocations to healthcare and technology stocks, which I believe should be considered among those groups as being the large dividend growers. We increased our exposure to real estate through our holdings of REITs. As you know, for those of you that look carefully at your portfolios, you will notice that REITs do represent a fairly large position within those portfolios. And we do that for a reason. First, we think REITs are economically sensitive. They are correlated with the economy, and they do well in rising markets. They also pay very handsome dividends, and we see this as a way to enhance income in the portfolio. And we think, based on our outlook for continued positive growth, reasonable, good growth for the U.S. economy, that the real estate market should continue to be healthy, and that should be reflected in the holdings of REITs, which we have included in your allocations. And finally, again, I won't spend much time on fixed income, but I would reiterate that I think we spent a larger than normal portion of our discussion this quarter on fixed income. It has been as you've heard us use the word historically, it's been a conundrum for wealth managers going through this whole process of understanding what's happening in the fixed income world. We're really in uncharted waters with respect to quantitative easing and how the Fed has increased its balance sheet over the last several years. So it has created some issues with respect to fixed income that we have been grappling with. And I would just concur with Len that I really feel good about the solution that we have proposed for fixed income, where we are underweighting the long end and overweighting the short end. And those short bonds really should benefit as maturities roll off. If rates do go up, new purchases in those short bonds should be at higher rates, which will enhance your income going forward. So with that, I would like to turn it back to Stan for some wrap-up comments.
Thanks, Bob. As you can see, it was really a very interesting session, and frankly, it was a rather long session. But the overall strategy, again, definitely mirrors our absolute desire to make sure that you are as well diversified as possible through those different groups and different investment styles. And we feel very comfortable that we will be representing our investments quite efficiently for this quarter and frankly for the quarters upcoming, especially with that change in our bond strategy. So again, thanks for tuning in, and we'll look forward to seeing you again next quarter.